Codename Cellar Boxing. Forum leak 2004, Sunday, March 7th, 2004 at 7:56 p.m. Cellar Boxing. There's a form of the securities fraud known as naked short selling that is becoming very popular and lucrative to the market makers that practice it. It is known as cellar boxing, and it has to do with the fact that the NASD and the SEC had to arbitrarily set a minimum level at which a stock can trade. This level was set at $0.0001 or 1/100th of a penny. This level is appropriately referred to as the cellar. This 1/100th of a penny level can be used as a backstop for all kinds of market maker and naked short selling manipulations. Cellar boxing has been one of the security frauds du jour since 1999, when the market went to a decimalization basis. In the pre-decimalization days, the minimum market spread for most stocks was set at 1/8 of a dollar, and the market makers were guaranteed a so-called healthy spread. Since decimalization came into effect, those 1/8 of a dollar spreads now are often only a penny, as you can see in Microsoft's quote throughout the day. Where did the unscrupulous MMs go to make up for all of this lost income? They headed south to the OTCBB and pink sheets, where the protective effects from naked short selling like Rule 10A and NASD Rules 3350, 3360, and 3370 are non-existent. The unique aspect of needing an arbitrary cellar level is that the lowest possible incremental gain above this cellar level represents a 100% spread available to MMs making a market in these securities. When compared to the typical spread in Microsoft of perhaps 0.4%, this is pretty tempting territory. In fact, when the market is no bid to 1/100th of a penny offer, there is theoretically an infinite spread. In order to participate in cellar boxing, the MMs first need to pummel the price per share down to these levels. The lower they can force the share price, the larger are the percentage spreads to feed off of. This is easily done via garden variety naked short selling. In fact, if the MM is large enough and has enough visibility of buy and sell orders as well as order flow, he can simultaneously be acting as the conduit for the sale of non-existent shares through Canadian co-conspiring broker or dealers and their associates with his right hand at the same time that his left hand is naked short, selling into every buy order that appears through its own proprietary accounts. The key here is to be a dominant enough of a MM to have visibility of these buy orders. This is referred to as broker or dealer internalization, or naked short selling via desking, which refers to the market maker's trading desk. While the right hand is busy flooding the victim company's market with counterfeit shares that can be sold at any instant in time, the left hand is nullifying any upward pressure in share price by neutralizing the demand for the securities. The net effect becomes no demonstrable demand for shares and a huge oversupply of shares, which induces a downward spiral in share price. In fact, until the beefed-up version of Rule 3370, affirmative determination in writing of borrowability by settlement date, becomes effective, US MMs have been legally processing naked short sale orders out of Canada and other offshore locations, even though they and the clearing firms involved knew by history that these shares were in no way going to be delivered. The question that then begs to be asked is how the system can allow these obviously bogus sell orders to continue to clear and settle. To find the answer to this one need look no further than to Addendum C to the rules and regulations of the NSCC subdivision of the DTCC. This gaping loophole allows the DTCC, which is basically the 11,000 BDs and banks that we refer to as Wall Street, to borrow shares from those investors naive enough to hold these shares in street name at their brokerage firm. This amounts to about 95% of us. Theoretically, this borrow was designed to allow trades to clear and settle that involved legitimate 1 or 2 day delays in the delivery. This borrow is done unbeknownst to the investor that purchased the shares in question and amounts to probably the largest conflict of interest known to mankind yet. The question becomes, would these investors knowingly loan, without compensation, their shares to those whose intent is to bankrupt their investment if they knew that the loan process was the key mechanism needed for the naked short sellers to effect their annual goal? Another question that arises is, should the investor's BND, who just earned a commission and therefore owes its client a fiduciary duty of care, be acting as the intermediary in this loan process, keeping in mind that this BND is being paid the cash value of the shares being loaned as a means of collateralizing the loan, all unbeknownst to his client, the purchaser. An interesting phenomenon occurs at these seller levels. Since NASD Rule 3370 allows MMs to legally naked short sell into markets characterized by a plethora of buy orders at a time when few sell orders are in existence, AMM can theoretically, legally sit at the 1/100th of a penny level and sell non-existent shares all day long, because at no bid and 1/100th of a penny ask, there is obviously a huge disparity between buy orders and sell orders. What tends to happen is that every time the share price tries to get off of the seller floor and onto the first step of the stairway at 1/100th of a penny, there is somebody there to step on the hands of the victim corporation's market. Once a given micro-cap corporation is boxed in the cellar, it doesn't have a whole lot of options to climb its way out of the cellar. One obvious option would be for it to reverse split its way out of the cellar, but history has shown that these are counterproductive, as the market capitalization typically gets hammered, and the post-split share price level starts heading back to its original pre-split level. Another option would be to organize a sustained buying effort and muscle your way out of the cellar, but typically there will, as if by magic, be a naked short sell order there to meet each and every buy order. Sometimes the shareholder base can muster up enough buying pressure to put the market at 1/100th of a penny bid and 2/100th of a penny offer for a limited amount of time. Later, the market makers will typically pound the 1/100th of a penny bids with a blitzkrieg of selling to wipe out all of the bids, and the market goes back to no bid and 1/100th of a penny offer. When the weak-kneed shareholders see this a few times, they usually make up their mind to sell their shares the next time that a 1/100th of a penny bid appears, and to get the hell out of Dodge. This phenomenon is referred to as shaking the tree for weak-kneed investors, and it is very effective. At times, the market will go to 1/100th of a penny bid and 300th of a penny offer. This sets up a juicy 200% spread for the MMs and tends to dissuade any buyers from reaching up to the lofty level of 300th of a penny. If a 200th of a penny bid should appear from a MM not playing ball with the unscrupulous MMs, it will be hit so quickly that level 2 will never reveal the existence of the bid. The 1/100th of a penny bid at 300th of a penny offer market sets up a stalemate, wherein market makers can leisurely enjoy the huge spreads while the victim company slowly dilutes itself to death by paying the monthly bills with real shares sold at incredibly low levels. Since all of these development stage corporations have to pay their monthly bills, time becomes on the side of the naked short sellers. At times, it almost seems that the unscrupulous market makers are not actively trying to kill the victim corporation, but instead want to milk the situation for as long of a period of time as possible and let the corporation die a slow death by dilution. The reality is that it is extremely easy to strip away 99% of a victim company's share price or market cap and to keep the victim corporation boxed in the cellar. But it really is difficult to kill a corporation, especially after management and the shareholder base have figured out the game that is being played at their expense. As the weeks and months go by, the market makers make a fortune with these huge percentage spreads, but the net aggregate naked short positions become astronomical from all of this activity. This leads to some apprehension amongst the co-conspiring MMs. The predicament they find themselves in is that they can't even stop naked short selling into every buy order that appears, because if they do, the share price will gap. And this will put tremendous pressures on net capital reserves for the MMs and margin maintenance requirements for the co-conspiring hedge funds and others operating out of the more than 13,000 naked short-selling margin accounts set up in Canada. And, of course, covering the naked short position is out of the question, since they can't even stop the day-to-day naked short selling in the first place, and you can't be covering at the same time you continue to naked short sell. What typically happens in these situations is that the victim company has to massively dilute its share structure from the constant paying of the monthly burn rate with money received from the selling of real shares at artificially low levels. Then, the goal of the naked short sellers is to point out to the investors, usually via paid internet bashers, that with the, let's say, 50 billion shares currently issued and outstanding, that this lousy company is not worth the $5 million market cap it is trading at, especially if it is just a shell company whose primary business plan was wiped out by the naked short sellers' tortuous interference earlier on. The truth of the matter is that the single biggest asset of these victim companies often becomes the astronomically large aggregate naked short position that has accumulated throughout the initial bear raid, and also during the cellar boxing phase. The goal of the victim company now becomes to avoid the three main goals of the naked short sellers, namely bankruptcy, a reverse split, or the forced signing of a death spiral convertible debenture out of desperation. As long as the victim company can continue to pay the monthly burn rate, then the game plan becomes to make some of the strategic moves that hundreds of victim companies have been forced into doing, which includes name changes, QSIP number changes, cancel and reissue procedures, dividend distributions, amending of bylaws and articles of corporation, etc. Nevada-domiciled companies usually cancel all of their shares in the system, both real and fake, and force shareholders and their BNDs to prove the ownership of the old real shares before they get a new real share. Many also file their civil suits at this time also. This indirect forcing of hundreds of U.S. micro-cap corporations to go through all of these extraneous hoops and hurdles as a means to survive, whether it be due to regulatory apathy or lack of resources, is probably one of the biggest black eyes the U.S. financial systems have ever sustained in history. In a perfect world, it would be the regulators that periodically audit the C and D sub-accounts at the DTCC, the proprietary accounts of the MMs, clearing firms, and Canadian BNDs, and force the buy-in of counterfeit shares, many of which are hiding behind altered QSIP numbers that are detected above the Rule 11830 guidelines for allowable failed deliveries of 0.5% of the shares issued. U.S. micro-cap corporations should not have to periodically purge their share structure of counterfeit electronic book entries. But if the regulators will not do it, then management has a fiduciary duty to do it. A lot of management teams become overwhelmed with grief and guilt in regards to the huge increase in the number of shares issued and outstanding that have accumulated during their watch. The truth, however, is that as long as management made the proper corporate governance moves throughout this ordeal, then a huge number of resultant shares issued and outstanding is unavoidable and often indicative of an astronomically high naked short position and is nothing to be ashamed of. These massive naked short positions need to be looked upon as huge assets that need to be developed. Hopefully, the regulators will come to grips with the reality of naked short selling and tactics like cellar boxing, and quickly address this fraud that has decimated thousands of U.S. micro-cap corporations and the tens of millions of U.S. investors therein.